The Dow Jones just set an all-time record close, above 5,800. On the same day, traders fully priced a Fed rate hike for the first time since the Iran war began. Those two facts do not belong in the same sentence, and that contradiction is where today's analysis begins. Kevin Warsh was sworn in Friday as the 17th Federal Reserve Chair, the most hawkish appointment in 2 decades, according to Franklin Templeton's fixed income chief. Within hours of the ceremony, Fed Governor Christopher Waller stated it would be crazy to discuss rate cuts and declared the next move is just as likely to be a hike. CME FedWatch data moved immediately, a 52.2% probability of a rate increase at the October 28th meeting, up from near zero odds a week ago. What Waller's language unlocked was not new information about inflation. The Iran war's energy shock has been visible since late February. What it unlocked was the position pressure that had kept institutional bond shorts contained. Long yields on 30-year government debt are now at their highest level in almost 2 decades, a move that Societe Generale's head of U.S. rate strategy flagged as having room to run. The surface reading, Warsh's hawkish, yields rise, equities fall, did not materialize. The S&P 500 closed out its 8th consecutive weekly gain, the longest streak since late 2023. Retail and momentum flows, which had been the primary driver of the winning streak, absorbed the yield surge without visible exit. Institutional net flow data interpreted from intraday price action shows passive funds held positions, rather than rotating into bonds, suggesting the October hike probability at 52% remains in the zone where equity holders price optionality, not certainty. But 52% is not a stable equilibrium. The University of Michigan's final May consumer sentiment reading fell to 44.8, a record low in the survey's 74-year history, below readings from the 2008 crisis and COVID shutdowns. Long-term inflation expectations jumped to 3.9% annualized over 5 to 10 years, the highest in 7 months. When sentiment collapses at this depth while markets climb, one of two things is true. Either equities are pricing a peace deal that hasn't happened, or a participant class is still holding that has not yet reconciled with what a rate hike at 3.75% means for valuation multiples. The June 16-17 FOMC meeting is the first test under Warsh's leadership, and it arrives before October.
The rate hike repricing that pressured rate-sensitive equities created an anomaly inside the technology sector. The quantum computing names moved in the opposite direction, and the mechanism that insulated them is the same mechanism that may sustain them even if Warsh delivers a hike. The U.S. Commerce Department announced $2 billion in CHIPS Act funding distributed across 9 quantum firms, including a $100 million commitment to Rigetti Computing, specifically for manufacturing scale, and a $375 million package to Global Foundries to build a dedicated quantum wafer foundry. IBM secured a separate $1 billion deal from the Trump administration, with Wedbush calling the quantum investment a new catalyst for the stock, language that in positioning terms means sell-side coverage was repositioning, not summarizing. IonQ rose nearly 23% on the week on sector momentum, while Rigetti surged approximately 50% and Inflection jumped 41%. The critical distinction from the rate sensitivity frame is this: government-directed capital does not reprice with the Fed funds rate. The $2 billion commitment is appropriated demand. It does not shrink when the 10-year yield rises, because the buyer is not a return-maximizing portfolio. Institutional flows that had previously treated quantum as a speculative technology trade are now re-examining the allocation frame. This is no longer purely a venture stage bet on technical milestones, but a sector with a federal procurement floor. France added €1.55 billion to quantum and chip investment on the same day, and Macron's announcement confirmed a coordinated Western government posture on quantum infrastructure spending. That foreign capital signal reached domestic quantum names through the recognition that U.S. funding is competing against, not leading, a global government investment race, which strengthens the durability argument for the appropriated demand floor. What the government funding does not resolve is the valuation gap. Rigetti trades at a price-to-sales ratio above 590x. IonQ's revenue surged 755% year-over-year to $64.67 million in Q1, but the stock's 20% run into the week had already embedded that beat. The position pressure question the rate hike frame forces on quantum is whether the government demand floor is large enough to justify current multiples, or whether the sector has pulled forward 2 years of repricing into 6 weeks of trading.
The question that the quantum sector's government backstop leaves open is the same question that made Warsh's hawkish signal credible on day one. The Iran war has not ended, and until it does, every forward assumption in both the rate framework and the sector spending framework sits on an unresolved geopolitical variable. Brent crude fell more than 5% on the week as U.S.-Iran peace talks showed progress, with Secretary of State Marco Rubio describing some good progress and Arab media reporting a draft agreement was close to being announced.
That decline was the market's largest weekly oil move since the conflict began, and it temporarily lifted the equity ceiling. The Dow record and the S&P's eighth winning week both occurred inside a window where the peace probability was rising, but Brent still closed above $103 per barrel. The UAE's ADNOC chief stated that full oil flows through the Strait of Hormuz will not normalize before the first or second quarter of 2027, even if a deal is signed this weekend. That supply restoration timeline is what makes Waller's rate hike language durable rather than performative. Americans are paying $45 billion more for fuel since the Iran war began. Gas prices are at a 4-year high at $4.55 per gallon nationally, and grocery chains are absorbing fuel and labor cost pressure simultaneously. The stagflationary configuration, record low consumer sentiment alongside record equity levels, is held together by one assumption: that the energy shock resolves fast enough to prevent the inflation expectations already embedded in the 5 to 10-year Michigan survey from becoming self-fulfilling. Capital that moved into equities this week did so on Iran peace optionality, not on fundamental macro improvement. Foreign institutional positioning interpreted from dollar strength, the Bloomberg Dollar Spot Index rose on Waller's comments, shows that the rate hike signal was absorbed as a bond short, not as an equity exit trigger. That distinction matters because it is fragile. If the Iran deal fails and Brent reclaims 110, the same foreign participants pricing a December hike will reprice it to June. The equity market's current participant structure, passive holders, momentum flows, around peace optionality buyers, is not designed to absorb a simultaneous bond sell-off and oil price spike. The verification variable available within 48 hours is whether Iran and the US produce a formal agreement announcement over the weekend. If no deal is announced by Monday's open and Brent holds above $100, the October rate hike probability at 52% becomes a floor rather than a ceiling, and the S&P's 9-week streak becomes the test of whether passive inflows alone can hold the level that active institutional selling would challenge. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.